Welcome back to Boni's Life. I'm your host, Boni, and today we are diving deep into a crypto market that just experienced one of its most turbulent and defining weeks of the year. If you invested $100 in Bitcoin at the start of this week, you would be down roughly $4.56 today, as Bitcoin slid from over $77,200 to just under $73,800. A similar $100 spot position in Ethereum would have lost you $4.36, and Solana would have set you back $2.86, but these small percentage drops mask a violent underlying reality. Between May 25th and May 31st, 2026, we witnessed a historic $1 billion liquidation cascade, driven by escalating geopolitical tensions in the Middle East and a structural fragility in the derivatives market. We saw US airstrikes near the Strait of Hormuz erase $80 billion in crypto market cap in a single session, while institutional capital fled, marking a record 9 consecutive days of outflows from spot Bitcoin ETFs totaling $2.8 billion. Today, we are going to dissect exactly what moved these markets, analyze the critical technical triggers, and map out the high probability trading scenarios for the week ahead, because the data suggests we are standing at a major crossroads. To understand why the market broke down the way it did, we have to look beneath the surface of the spot price and examine the derivatives data from CoinGlass. By Wednesday, May 28th, the market had become dangerously overleveraged, crowded with late-cycle long positions that were vulnerable to any macro shock. That shock arrived in the form of U.S. Central Command airstrikes on an Iranian military site near the Strait of Hormuz, following drone attacks on commercial shipping. The geopolitical flashpoint triggered a massive de-risking event. According to CoinGlass data, a staggering $958.8 million in leverage positions were forcibly closed in just 24 hours. What is truly remarkable is that 93% of those liquidations, $897 million, were long positions. Over 167,000 traders had their accounts wiped out, including a single $15.34 million Bitcoin long position on Hyperliquid. This was not just retail panic. This was a mechanical failure of a market loaded with oversized long exposure, meeting a sudden geopolitical crisis. When Bitcoin broke below the $74,000 support level, it triggered a cascading effect that temporarily dragged the price below $73,000, pulling Ethereum down below $2,000 and Solana down to $80. Compounding this derivatives flush is a deeply concerning trend in institutional flows. For the first time since their launch in January 2024, US spot Bitcoin ETFs have recorded 9 consecutive days of net outflows. This week alone, we saw $1.3 billion exit these funds, bringing the total withdrawal over this 9-day streak to $2.8 billion. BlackRock's IBIT led the withdrawals, shedding nearly $178 million in a single session on Tuesday. This institutional exodus suggests that smart money is reallocating capital away from Bitcoin and toward high-flying AI and semiconductor equities, which continue to dominate the traditional markets. The ETF data tells us that the spot demand required to absorb the massive supply overhang simply was not there. However, it is not all bearish news. Historically sustained ETF outflows of this magnitude, when viewed through Glassnode's 14-day moving average, have often coincided with periods of market stress that eventually form local bottoms, similar to the corrections we saw earlier this year when Bitcoin briefly fell towards $60,000 in February. The key question now is whether open interest can rebuild on genuine spot demand, or if the market remains vulnerable to another leverage-driven flush. Looking ahead to the upcoming week of June 1st to June 7th, the macroeconomic calendar is loaded with high-impact events that will directly influence crypto valuations. The Federal Reserve's target rate sits at 3.50 to 3.75%, and the market is desperate for clues ahead of the mid-June FOMC meeting. We kick off on Monday with the final US S&P manufacturing PMI and the ISM manufacturing PMI, which came in at 51.8 last month and will give us a read on industrial health and inflation pressures. The preliminary reading was 55.3, the strongest since May 2022. Tuesday brings the JOLTS job openings report, previously at 6.8 million, a critical gauge of labor demand. But the main events hit later in the week. Wednesday features the ADP employment change, previously at 96,000 jobs, and the Federal Reserve's Beige Book, setting the stage for Friday's blockbuster Non-Farm Payrolls report. The labor market has been in a low-higher, low-fire equilibrium, and any significant deviation from the expected 100,000 to 150,000 job additions will send shockwaves through U.S. Treasury yields and the U.S. dollar index. A hotter-than-expected jobs report will reinforce the higher-for-longer interest rate narrative, which is fundamentally bearish for risk assets like Bitcoin. Conversely, softer economic data could lower bond yields and provide the macro tailwind crypto desperately needs to reclaim the $75,000 level. Beyond the traditional economic data, we must also navigate significant crypto-specific and geopolitical developments in the coming days. The US and Iran have reportedly reached a tentative 60-day ceasefire agreement which has temporarily stabilized oil prices and risk assets. However, the situation remains highly volatile, with Brent crude still above $100 per barrel, and any breakdown in these talks regarding the Strait of Hormuz will immediately inject fear back into the markets. On the regulatory front, we are seeing major structural shifts. The Commodity Futures Trading Commission has just approved the first regulated Bitcoin perpetual futures contracts in the United States at Kalshi and Coinbase, transitioning these instruments out of the regulatory gray area and into the mainstream. Furthermore, the CME Group has officially launched 24/7 trading for its crypto futures and options, eliminating the infamous weekend gaps that have historically plagued Bitcoin price action. This is a massive step toward fully integrated institutional adoption. Additionally, we are tracking over $650 million in token unlocks this week, which will introduce significant new supply into the altcoin market and could suppress prices for specific projects. The US government has also seized approximately $1 billion in Iranian cryptocurrency as part of its expanded pressure campaign. So, how do we trade this complex environment? Let me break down the technical scenarios and probabilities. Scenario A, which I assign a 40% probability, is the bearish continuation. If Bitcoin fails to hold the $73,000 level on rising volume and ETF outflows persist into next week, the next structural support floor drops to the $70,000 zone. This area contains a secondary liquidation cluster visible on CoinGlass heatmap data and prior consolidation support. If macro data comes in hot this week, driving up the dollar index, a breakdown to 66,400 becomes a highly probable technical target. Scenario B, with a 35% probability, is the consolidation and reset. Here, Bitcoin holds the low 70,000s. Funding rates neutralize over a 48 to 72-hour window, and open interest rebuilds slowly based on spot buying rather than leverage. This would be a healthy reset, allowing the market to digest the recent $1 billion liquidation event before making its next major move. Finally, Scenario C, the bullish reversal, carries a 25% probability. This requires a dovish surprise in Friday's non-farm payrolls data, a cessation of ETF outflows with confirmed institutional re-entry, and a decisive daily close above $75,000. If these conditions are met, the path is clear for a retest of the $77,000 range. To navigate this week successfully, you must be a multidimensional thinker. Do not get caught in the noise of mainstream narratives. Watch the funding rates on perpetual venues. If they remain elevated, the long book is still too crowded and the market is vulnerable to another flush. Monitor the daily ETF flow data from so-so value for signs of institutional re-entry, because that is the single most important signal that the selling pressure has exhausted itself. And above all, keep a close eye on the US Treasury yields and the dollar index, as they remain the ultimate gravitational force on crypto prices right now. The market has just flushed out the weak hands, creating a potential opportunity for those who understand the underlying mechanics. Stay disciplined, manage your risk, and wait for the structural triggers to confirm the trend before deploying capital. Thank you for joining me on this deep dive. If you found this level of analysis valuable, make sure to subscribe, leave a comment with your thoughts on the upcoming non-farm payrolls report and how you think it will impact Bitcoin, and share this episode with anyone who needs to understand what is really happening in crypto right now. I am Boni, and I will see you in the next update.